Hello and welcome to the Business Standard Morning Show. I'm Debarghi Sanyal, and here's a look at the stories for the day. The government has proposed a slew of changes to the 6-year-old Insolvency and Bankruptcy Code and has also sought suggestions from the public. The aim is to fast track the resolution process and strengthen the functioning of IBC. So, will the proposed overhaul make the insolvency resolution process more effective? Bhashwar Kumar brings you the answer.
GST and the Insolvency and Bankruptcy Code, or IBC, were the two biggest reforms that the BJP-led central government ushered in during its first term. While GST is still going strong after a few good years, the IBC seems to be losing steam. It might do well to increase financial flexibility and help in speedy repurposing of capital. Data shows that it may not have been as effective. In December, the government told Parliament that almost half of the cases which were not closed under the corporate insolvency resolution process stretched beyond the IBC's extended deadline of 270 days. According to the RBI's Trend and Progress report for 2021-22, legacy systems like the SARFAESI and debt recovery tribunals had recovery rates comparable to the IBC mechanism. The IBC's recovery rate stood at almost 24%, while the rates under the SARFAESI Act and DRTs stood at almost 26% and over 22% respectively. The cumulative recovery rate under the IBC stood at just a shade over 30% at the end of the second quarter of FY23. The recovery rate, which implied a haircut of about 70% for lenders, fell steeply from 43% in the first quarter of FY20. This is what an analysis of IBC data done by Care Ratings showed. Now, the Corporate Affairs Ministry has proposed sweeping changes to the IBC. The aim is to bring more transparency, speed, and technology to the resolution process. Broadly, the draft proposal includes 4 important changes. It seeks to give more power to adjudicating authorities. It allows mandatory admission of insolvency applications filed by financial creditors. It seeks a specialized framework for real estate. And it looks at expanding the scope of the pre-packaged insolvency scheme beyond MSMEs. The code may also be amended to segregate the concept of the resolution plan from the manner in which the proceeds from a successful resolution are distributed. A new mechanism that will ensure an equitable distribution scheme has also been proposed to make the process fairer. A state-of-the-art e-platform for case management, automated file application processes, delivery of notices, interaction between insolvency professionals and stakeholders, and storage of corporate debtor records have also been proposed. These are supposed to benefit regulators and adjudicating authorities by providing them consolidated information. To mitigate delays and value destruction, the Committee of Creditors may be mandated to transparently look into competing plans through an appropriate challenge mechanism. The draft proposal looks to give adjudicating authorities the power to impose penalties to discourage frivolous applications. The code may also be amended so that adjudicating authorities can bar a promoter who has committed repeated or substantial contraventions from being a resolution applicant. Another proposal is to boost the Insolvency and Bankruptcy Board of India's power to issue a show cause notice without investigation or inspection, in case sufficient material is available on record. Overall, will the proposed IBC overhaul make insolvency resolution more efficient and effective?
On whether it will result in better recovery rates, I think that's a function of what's the value of the underlying asset that is coming into the resolution mode. But to the extent they have proposed several measures to get a better outcome, I believe it will increase the recovery rates. On segregation of resolution and distribution, I think in several cases the NCLTs were anyway trying to achieve that. There are cases where disputes between creditors were pending. So the NCLTs have encouraged or supported measures by which the resolution can be completed vis-a-vis the acquirer and issues of distribution can go along. I think that's something which can be considered. I think any form of challenge mechanism will be good both for the creditors and for the acquirers. It gives you certainty of process, which is what all the acquirers have been asking for. But more importantly, from the creditors' point of view, it will ensure that they get the best value for the asset in question. I think the biggest measure which they have proposed, which requires more debate, is the change to the distribution formula under Section 53. That has far-reaching implications. It will have far-reaching implications on how credit decisions will be made. It will have far-reaching implications on whether there will be a distressed credit market which will develop. Because far from being prescriptive under Section 53, they have proposed something very different, which has been used in other resolutions under Companies Act earlier. So that, I think, is the most important change which has been proposed. And I think that change requires more deliberation and consultation.
Majority of the changes that they are proposing should make a significant advantage in terms of timelines, at least, if not anything else.
The government has also proposed that the pre-packaged insolvency regime that applies to small businesses could be expanded to other prescribed categories of corporate debtors. However, the pre-packaged insolvency process for MSMEs has not taken off in a big way yet. So, whom would this proposal help and how?
When the first leg itself hasn't, been so successful, I don't know if applying that same thing to other entities, how successful it will be. But on the other hand, maybe MSMEs have not been able to get advantage out of it. And if the scope is actually widened in terms of the debt value, where, debt value is small, but the resolution plans are stuck in before the adjudicating authorities for approval for a longer time, and where traditional CRP provisions are applicable. Maybe for smaller debt value companies, this may actually be helpful, and the number of approvals under pre-pack might go up.
For real estate projects, the government has proposed that the IBC be amended to enable the transfer of ownership and possession of a plot, apartment, or building to allottees with the consent of the Committee of Creditors. This is not allowed currently.
At the first blush, it looks quite promising, if I think from the allottee side, where they've been stuck and the property is not being transferred in their name and so on and so forth. But I feel it's too high an onus on the RP to allow this kind of transfer of ownership to the allottees during the CIRP period, because maybe a majority of them will fall through and there are no complications later. But I perceive that the litigations to reverse that may, go up post after the CIRP is over, when these transfers are done.
While the proposed changes are by and large viewed positively by experts, ensuring that the IBC returns to time-bound performance will also require a solution to the understaffing of the NCLT by the government. The government must invest in its own major reform so that it can perform up to expectations.
A bill to amend the IBC is likely to come up in the budget session of Parliament. Meanwhile, India's education sector is also crying for the budget makers' attention. A recent countrywide survey has revealed that India's school students have regressed in their basic reading ability to pre-2012 levels, while their basic math skills declined to 2018 levels. Is this then a wake-up call for policymakers to turn their focus on school education? Here's a read of the finer print. The pandemic robbed 2 years of the Indian students' school life, and when the schools reopened, children dusted off their bags and returned to schools, posing a fresh challenge for the teacher. While the students' enrollment increased to more than pre-pandemic levels, their learning gap had widened. The Annual Status of Education Report, or ASER 2022, a household survey conducted across 616 rural districts, has just confirmed that the students' foundational skills in reading and arithmetic had regressed. The national level survey shows that despite school closures during the pandemic, the overall enrollment figures, which have been above 95% for the past 15 years, for the 6 to 14-year age group, increased from 97.2% in 2018 to 98.4% in 2022. The report also mentioned that government schools have seen a sharp increase in children enrolled from 66% in 2018 to 73% in 2022, reversing another trend of a steady decrease in student enrollments since 2006. So, what does this really mean?
The findings, there are two main areas of findings of the ASER 2022 report. One is on the enrollment side, and the other is on the learning side. And I actually see both of these, rather than being negative findings, actually quite positive findings. We were almost close to universal enrollment even in 2010 when Right to Education came into effect. So this is, to me, the fact that the pandemic didn't interrupt this. The second big thing in the enrollment is that we are seeing a huge increase in government school enrollment.
According to Wadhwa, the government schools have done well in distributing textbooks as well as midday meal ration during and after the pandemic. This, she believes, may have been crucial in increasing government school enrollment. The challenge for government schools would be to now retain this enrollment. But this growth was not without its challenges.
In 21-22, only 37% of government and aided schools had computers. In fact, the number of schools with computers has declined compared to the previous year, and 27% had an internet connectivity. So while we were trying to find ways of ensuring that children continue learning, which is of course hard when you don't have the infrastructure, plus we know that for younger children, it's really hard to do online classes in the same way. So considering all of that, I think ASER does have relatively good news that it's not as bad as it could have been.
But the drop in learning ability is a concern. The basic reading ability of school students across all classes has dropped to pre-2012 levels, while basic math skills have declined to 2018 levels.
Yes, indeed, we see some learning loss. But these numbers hide a lot of things. One is they hide the variation across the country. In some sense, the learning loss kind of had happened, and what you're seeing is recovery. So for other states, I don't know how low it went, right, in terms of to be able to say. So here again, in fact, I see these numbers more as a story of recovery rather than a loss. But having said that, there has been a loss. Now, the thing is that now that a national goal has been set, the momentum is there. States are already moving and different states have put in different initiatives to deal with this. And I feel that if they hadn't done this, we would have seen a much bigger learning loss. So I do believe that there has been a recovery.
Kapoor, highlighting the report's implication on the impending budget, also believes that the current fiscal year has been a good year for the education budget. This year saw the largest budget allocation for Samagra Shiksha scheme, which was launched in 2018. Total allocation for the scheme so far has been nearly 38,000 crore rupees. Almost 27% of the budgeted allocation for the current fiscal is aimed at improving the quality of educational infrastructure. Since education is a concurrent subject and a large portion of the state budget goes towards paying teachers' salaries, the central fund plays a crucial role. And this is why Kapoor says that the Samagra Shiksha scheme is crucial for states.
Samagra Shiksha is the biggest platform. It is going to be the way that the union government can ensure that there is enough finances for states to focus on the things that they need to. See, I don't necessarily think that it's only a question of large amounts of money being pumped into education. It is also about making sure that children have that space and interaction with teachers. You have enough teachers for the number of children. You're able to talk to children based on their requirements, and teachers themselves are trained enough to be able to handle this gap in learning that we've seen.
Experts believe that the report, despite flagging the dip in the learning ability of students, actually indicates the robust recovery in wake of the post-pandemic reopening of schools. However, if this recovery is to be complete, the government will have to do more than pumping money into the country's educational infrastructure. They must also push for a comprehensive development of the teaching space in India's classrooms through policy innovations. In other news, sports to energy player Adani Enterprise has announced a follow-on public offering worth 20,000 crore rupees. The FPO will open from January 27 and close on January 31. However, a day after the announcement, shares of the company slumped over 4% to hit a 2-month low of 3,446 rupees per share. However, analysts recommend subscribing to the offer as they reiterate the conglomerate's large play on renewable energy. Lavisha Darad brings you a detailed report.
The 20,000 crore rupee FPO of Adani Enterprises will open for 5 days from January 27th onward, with a price band set in the range of 3,112 to 3,276 rupees per equity share. While the floor price is at 10% discount to the Thursday's closing price of the stock, the top end is 5.4% below. Retail investors are being offered an additional discount of 64 rupees. Around 50% of the portion of this offer is reserved for qualified institutional buyers, QIBs, 35% is for retail investors and 15% for high net worth investors, HNIs. Since Adani Enterprises is an incubator of all businesses, analysts expect the renewable energy play to be gradually incubated as well.
It's a good case to buy this stock into the portfolio, given the kind of allocation of money that they would be having towards renewables and toward road assets primarily, and also along with that, I think the other infrastructure assets, including airport. So, I would think rather that I think this particular company remains relatively more positive proposition than before. Two reasons. One, renewable is the next level of growth provider into the economy. And as a result of it, any company who is focusing large into renewable, I think they would probably be the one which would be attracting a lot of amount of investment into them at every given point of time. Now, I think from the perspective of investors, shareholders, I think this is equally, I think, a good track record that the company has built. Adani Enterprise is an incubator of all businesses. So renewable is also going to be incubated into the books of Adani Enterprise, which I believe, I think at some point of time would be divested and demerged into a separate company as their charter goes. So from that perspective, I believe that I think this is a good opportunity to buy this stock into the portfolio. Since it is likely to be the warrant based or I think the partly paid based investment at this point of time, it could possibly also give investor opportunity to pay money not upfront but over a period of time. So from that point of view too, I believe that I think for investors, I think this would remain a good proposition.
Adani Enterprises plans to utilize the net proceeds from the offer towards funding of capital expenditure requirements of some of its subsidiaries and debt repayment of certain borrowings of the company and 3 of its subsidiaries. Besides, it will also be used towards construction of greenfield expressways, improvement works of certain airport facilities, certain projects of green hydrogen ecosystem and other general corporate purposes. Given this, analysts expect shares of Adani Enterprises to re-rate in the long term.
The FPO sees the company on a rapid expansion spree. They are putting in place a hydrogen platform which is going to be a $50 billion investment, and for that they would need to raise money, right? So for that they're diluting equity 10% now, and we expect that they will dilute. They will also undertake some kind of equity stake they will give out in their airports business very soon. So while they're going to be raising money going ahead also, we believe that there are significant triggers to for a re-rating of the stock to take place. Currently, because we see a close to 80% upside from this level. So our target is about 6,000 from current levels.
Today, investors will watch out the third quarter performance of index heavyweight Reliance Industries after the market hours. Analysts expect RIL's Q3 performance to be led by telecom and retail businesses, while a sequential recovery in oil to chemicals division may be partly offset by fuel export taxes and weak petrochemical margins. As per Bloomberg consensus estimates, the conglomerate is likely to clock 25.7% year-on-year net sales growth to 2.3 trillion rupees in the third quarter of FY23. Profit after tax, on the other hand, may decline nearly 10% YOY to 16,759 crore during this quarter. Besides foreign flows, crude oil prices and global cues will dominate market mood on Friday.
Indian markets snapped a 2-day winning streak due to weak US economic data on Thursday. Meanwhile, most business leaders of the world are in Europe. Very few events on the earth boasts of such an impressive and long list of guests. Every year, hundreds of business tycoons, politicians, and billionaires who can make some difference to this world pack their bags and head to Davos for the annual World Economic Forum meeting. Today, we tell you more about this forum, how it came into being, and what purpose it serves.
This is the part of the year when hills surrounding Davos are laden with snow and hotels with high-profile guests. Leaders from across the world flock to this Swiss town to attend the annual World Economic Forum meeting. Government heads, politicians, economists, celebrities, investors, business leaders, journalists, all are in attendance here, separated by colored badges. The white one with the hologram is the most coveted. Only government policy makers and select WEF employees get it. Journalists get an orange badge which restricts their entry. The annual World Economic Forum meeting is being held between January 16 and 20. Some 2,700 paying members and scores of invitees are taking part in the 5-day event to discuss global issues in about 500 sessions. But what led to the formation of this forum and when? Let us take a trip down the memory lane. The urge among European business leaders to become more competitive than their American counterparts led to the formation of this forum. In 1971, German professor Klaus Schwab had called a meeting of European business leaders at Davos. The agenda was to come up with ways to become more competitive. Over 400 business leaders from 31 countries took part in the inaugural meeting of the European Management Symposium. Schwab had then said that Davos provided the perfect setting to host such an event. This meeting went on to become an annual affair later. And after the 1974 oil crisis, politicians and government heads also started getting invitations. And by 1987, as the size and clout of the institution grew, its name was changed to World Economic Forum. Currently, it is a non-profit organization which is funded by leading world companies. This year's theme, Cooperation in a Fragmented World, appears apt to the changing world scenario. Pandemic, increased protectionism, and Russia-Ukraine war have divided the world. World leaders are likely to brainstorm ways to find a solution to these vexed issues. They will also try to find ways to fix the broken supply chain too. Looming economic crisis and climate change too are on the top of the agenda. WEF Managing Director Sadia Zahidi's statement sums up the theme of this event. She said, leaders must look beyond today's crisis to invest in food and energy innovation, education and skill development, and in job-creating high-potential markets of tomorrow. There is no time to lose. From India, Union Ministers Ashwini Vaishnav, Smriti Irani, R.K. Singh and Mansukh Mandavia are attending the event. Chief Ministers of at least 3 states are also there, apart from about 100 business leaders including Mukesh Ambani, Gautam Adani, N. Chandrasekharan, Kumar Mangalam Birla and Adar Poonawalla. I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Over the years, the Davos event has lost its sheen. Critics believe that the movers and shakers of the world gather here only for light discussions. And the outcome of the 5-day event has hardly any impact on the real issues plaguing the world. That's all for today. For more news and analysis, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.